So this kind of is a great segue to our fourth thing that we look at. We talked about scalable infrastructure. So one of the solutions to actually solving both the owner-operator dependence and kind of embedding the secret sauce of the business is having good business systems. So identifying, I don't know if you remember on one of the earlier slides there, I had the idea that you need to identify key business processes. Well, actually embedding those in systems and in technology in a way that can be scaled is one way to actually take that dependence on certain individuals and make it systemic. That's one of the techniques. And what Buddy and I found is we're always looking for what we call operating leverage. Operating leverage is the ability to make an investment in kind of a core infrastructure that allows for scaling at a disproportionate output to the input. So basically saying we can grow revenues with very little incremental cost. And when you can get that mix, when you can get that equation, and in some businesses you can get a little differential, and in other businesses you can get great differential. I mean, if you think about software as a service business, that's the whole play, is you have tremendous operating leverage in software as a service. In staffing businesses, that's a lot harder to do, right? It's almost a one-to-one. Not quite, but it's tough. But we always look for that. And by being able to identify that and build systems and have them in place, and these aren't elaborate. Let me give you an example. When I went into JPS, everything was done in that business by spreadsheets. All purchasing, tracking, everything. Bills of materials, we're making boxes and software, so we had hardware. We did go through an implementation and put an ERP system in. And we didn't, it wasn't a tremendously fancy, but we put an ERP system in to really begin to capture and manage the flow of materials. And that sounds, as anybody that's done that, that's not a short-term project, right? It takes a lot of time. But tremendous difference, because the question is, if we're going to sell the company to a major strategic and we know that we can grow that business, how are we going to scale? We needed to be able to answer that question. And then, as you can imagine, once you have an idea from people to strategy to systems, you'll get some clarity on how much capital do you need and what's the right type of capital. And to us, that's how we think about, even from a fundraising perspective, we start even clicking off in this sequence. One of the things that we find is very helpful before you try to go to market, whether it's raising money, debt or equity, or selling the business, or doing an acquisition. I mean, we do about half our business is acquisition work, is try to clean up those shareholder issues that are really going to become a problem at some point, whether you have an estranged investor or a partner or there's some litigation in the background. It's amazing. But getting those things cleaned up in advance makes life a lot easier when you actually go to enter into a discussion. It is going to come out. It will always come out. And it's better to have thought about it and resolved it, or at least have a plan to mitigate it. So we try to think, I think the bottom line on this is shift from kind of a reactive mindset around capital formation to really trying to be proactive in managing the capital structure just as you would any other aspect of the business based on the stage and where that company is. It may be obvious, but why do we care about this? Because what we're trying to do is identify and be proactive in preparing for kind of the next stage of the company, no matter what that next step is. So then let me flip this now to, so we've talked a little bit about the fact that I hope that gave you a little data to convince you that maybe there's a valuation gap, and I bet from many of your experiences you probably see it in the marketplace. The second is that kind of a framework to big picture think about how do you get your head around a company, and then thirdly, all right, well, let's try to move to real value drivers and maybe end up with some things that you can really do or begin to act on to make a difference. So first off, I always like to start with a realization. Depending on how many CEOs I have or owners in the room, I always like to set realistic expectations about valuation. I told Eric last night, I said, please set the bar low for me. So anything I do, But this is a quick snapshot of EBITDA multiple data. So what you have on the left-hand side, these are EBITDA multiples. If you look at from 2 to 10, you've got different industry segments, but the summary is on the right, which is the averages, and it's based on average EBITDA multiples based on the size of EBITDA. So at the bottom is your 0 to $1 million in EBITDA with average multiples in the 4, and at the top are 50 million of EBITDA with average multiples of 8. Now, I'm sure we all know transactions that where we've got a $2 million company that sold for 10 or 12 times EBITDA. They do exist. That does happen, but that's not the norm. And I think that's the problem that we try to debunk with clients is that the norms are much lower than people talk about. So try to set a little bit of the one consistency if over time that you'll see with all valuation data is the bigger in general, the bigger the EBITDA, the higher the multiple. That generally holds true in most data sets. So that is one strategy is simply increasing the size of EBITDA prior to a sale. It does make a difference. And I have 3 slides I want to talk about framing valuation before we talk about tactical. And so the first one is this one, which is talking about it from a macro industry level. This is a chart that was created by McKinsey. Let me tell you about it, and then I'll zoom in on a couple of things on that chart. So it'll help you think about, it helps us think about the positioning of a particular company. All right, so on the y-axis, you have effectively the types of deals, these are M&A deals, relative to company size. So the top left is large company merging or buying large company. The bottom left is large company buying small company, okay? And then along the bottom, along the x-axis, left side is the lower value, which tends to be based on cost synergies or cost savings. And the right side is your higher values, and it's based on long-term strategic top-line synergies. So let's take an example. If you have an industry where there's overcapacity, there's too much capacity in the industry, and you basically are selling the same stuff, really you can value a deal based on cost synergies or cost savings. So a good example of that is go back a year ago where Office Depot and Office Max are merging. That's a deal which is basically trying to take capacity out of an industry. So you really can't value that deal. You're not going to get a lot of strategic synergy out of a deal like that because it's really a cost savings play. Let's go to the right side though, all right, which is big company and trying to transform an industry. So this is 2 big companies getting together that think they can create new market opportunities and create great growth and competitive position. And so you've got the ability to value that deal much more aggressively because you have a very strong future outlook. The best example I can come up with that, which didn't work very well, was AOL and Time Warner. If you guys go back and think about in 2000, when they put that deal together, that was supposed to change the world, right? That was supposed to be a transformative, industry-transforming transaction at the time. So now let's go into maybe a little more relevant for middle market businesses. So we're back at the left-hand side, and a roll-up is where you have big company buying small companies, and it's basically you're transferring kind of the core capability or the core strengths of the acquirer. You're leveraging brand, you're leveraging possibly some cost synergies and purchasing to a local level. A current example would be this company called USI. USI is a $1 billion company that's been aggregating insulation installers. And they have built up, constantly buying local installation installers and aggregating and using those cost synergies and brand synergies. So you can only pay for in a transaction like that, you can only frame that based on some of the cost-based, honestly, cost-based synergies. There are some revenue components, but most of it's cost-based. But let's go to the other side of the chart because I think this gets to why is this relevant. If you have big company buying a small company, and a lot of our clients are the small companies we're selling to strategics, we're trying to move them from the left side to the right in positioning. So what we're doing is we want the big company to see our client as a strategic bet. And JPS was that example. This was Raytheon, $22 billion company, bought a $10 million small tech business. Why would they do that? That's not going to move the needle. That's a rounding error in their P&L. They did it because it gave them the ability of a new technology which was going to increase their P-win, their probability of win on some very large programs, and it in itself could be a high-growth business. We had a plan. We were moving that business from, and what we pitched to them is we're going from $10 million to $100 million in a couple of years. And I'll tell you a little bit more about that and how we made that real in the negotiations. This type of framework is interesting because a lot of companies will be in one of these bottom left boxes in the middle market. And if you're going to do a transaction, we're trying to help move them to the right to increase their value from a strategic position. All right, that's pretty theoretical, right? But so I'll drill down a little bit more. How do you connect the big picture to a very tactical? Well, we found there are a number of things that impact value, some of which you can control, some of which you can't control in a deal, whether it's raising money or it's selling or buying. First is the competitiveness of the process. What's the general supply of capital and how competitive is the process? We have a lot of clients that come to us that are approached with an unsolicited offer that want to entertain and negotiate a deal. And you know, many times, you guys know, you're at a disadvantage if you're negotiating hand-to-hand combat one-on-one with a buyer or seller or an investor. So we're a big advocate of a competitive process to make sure you understand the market and can structure a good deal. What you're using the money for in a transaction makes a difference in valuation. You may say, and this may fly in the face of a lot of theories, but it does. If I'm going to raise capital and I'm going to take that money and I'm going to use it to buy out a partner so the money's flowing through the company out to a partner, that cost of capital is going to be more expensive than if I'm taking that money and leaving it in and investing and growing it. Same company, it's the use of funds that makes a difference in that cost of capital. How the capital markets look at the industry and the business you're in can make a big difference as to the value of the company. It's just part of that industry cycle. So understanding where you are can impact. That ties directly with industry dynamics. The one that I'll point on that you just can't forget, when we talk about valuation with middle market companies, you have to think deal terms hand in hand. They're not inseparable. You can't talk about the value of a particular transaction without knowing the deal terms. You guys know this, but I always have to remind business owners that you have to look under the hood to know what that really means. And it's a total value. So if you're in asset-based lending, I don't want to know just the interest rate, right? There's a lot more to that total cost of that relationship, that total cost of capital, than just the interest rate. And so each one of these, some of these are in your control and some aren't. And then I get kind of the tactical. So let me get down to a specific company. And these are some of the main things we see. And this probably resonates. Once again, it's one of those motherhood and apple pie kind of things. But the stage of the company makes a difference. Stage we see as having two characteristics. Stage is the history. In other words, is this a turnaround business? Or does it have a great long-term track record of positive earnings? That can be, you can begin to frame that as stage. The second one that you want to look at, though, in stage is what you may typically think about is this gone from a product, how proven are the products and services, how well adopted are they, how stable is pricing, things of that nature. Is it in a growth phase? Are we trying to really expand geographically? You can frame that whole stage discussion in different ways. The next one is and it links directly to it, is the whole earnings and cash flow history. The rate of growth obviously impacts valuation. If you look at any of the math, growth rates are one of the drivers. And then linking back to the fundamentals that talked about earlier, does the company have the foundation in place to get to the next stage, to do what it's wanting to do? And the stronger that foundation is, the better the argument is for a higher valuation in many cases, because it should show up in greater growth rates, it should show up in improved cash flow, a number of things. So it's directly linked to it. The other things that go into kind of the credibility of the forecast and the credibility of the numbers has to do with the type and the quality of revenue. Is it recurring revenue from existing customers? Is it a new customer? and new sales every time you're generating a dollar of revenue? How predictable is it? All of those things that you can envision feed into the risk profile of the company. So this, as I say, this is probably some things that you guys, everybody in this room already knows, but I'm trying to bring it together to say those are the things that we begin to then focus on. And so how do you actually make that into increasing the value of a company?